Borrowed to the brink? Will China's $322 billion stock loan bubble pop? China's investors have borrowed to the brink. Margin loans, money borrowed from brokers to buy stocks, have exploded to $322 billion, the highest in history. This isn't just a number, it's a massive debt-fueled gamble on the future of China's markets. But with stocks wobbling and global volatility rising, the big question is this mountain of debt sustainable, or is it a ticking time bomb about to go off? In today's urgent breakdown, we'll explore how China's borrowing binge could impact not only its own markets, but also Wall Street, commodities, and the entire global financial system. China's margin surge and market shudder. Margin trading has always been a double-edged sword. On the way up, it multiplies gains, fueling bullish momentum and investor euphoria. But on the way down, it magnifies losses, triggering forced sell-offs and cascading market crashes. Right now, China's margin debt has hit a record $322 billion, making it the largest stock loan bubble the country has ever seen. This surge comes just as Chinese markets are facing turbulence, with sharp corrections in recent weeks shaking investor confidence. We'll unpack what margin trading really is, why it became so popular in China, and how today's record borrowing compares to previous bubbles, like the 2015 crash when Chinese retail investors faced devastating losses. Global shockwaves from Shanghai to Wall Street. China isn't an isolated market. It's a central player in the global economy. A meltdown in Shanghai doesn't stay in Shanghai. It ripples out into Wall Street, Europe, and beyond. Already, we're seeing global jitters as investors brace for potential contagion. Commodities like copper and oil, so vital to China's industrial base, are vulnerable to swings in demand. Meanwhile, global stock markets like the S&P 500 are trying to rally on hopes of Fed rate cuts, but those gains could quickly evaporate if China's debt bubble bursts. In this section, we'll break down the channels of contagion, how Chinese investors' leverage can impact international credit flows, how multinational corporations tied to China could suffer, and why the dollar and gold are moving in response to this unfolding story. Perfect storm. Leverage, Fed policy, and tech fragility. What makes this moment especially dangerous is that China's leverage problem is colliding with other global fault lines. In the U.S., the Federal Reserve is weighing rate cuts as job growth cools, sending Treasury yields lower and reigniting speculative fervor. But easy money plus fragile investor sentiment is a dangerous mix. Meanwhile, Wall Street is already nervous about frothy AI stocks, with Goldman Sachs issuing fresh warnings about unsustainable valuations. Put it all together, record Chinese margin debt, dovish Fed signals, and fragile tech markets, and you have the ingredients for a perfect storm. We'll compare this setup to previous moments of global financial stress, from the 1997 Asian financial crisis to the 2008 credit meltdown. The jobs report trigger. In times of instability, small sparks can ignite huge fires. That's why the U.S. jobs report has suddenly become one of the most important pieces of data in the world. If job gains come in weak and unemployment rises, the Fed may feel forced to cut rates faster, encouraging even more leverage worldwide. If the report surprises on the upside, markets may reverse quickly, forcing Chinese investors already stretched thin on margin to dump positions en masse. This section will analyze how a seemingly domestic piece of U.S. data could end up being the trigger for a global chain reaction that starts with China's $322 billion margin mountain. Lessons from past bubbles. To understand where this is heading, we need to look back. China has faced margin-fueled manias before, most notably in 2015, when retail traders poured into the market using borrowed money, only to see trillions wiped out in a spectacular crash. Globally, we've seen the same pattern over and over. Debt-fueled asset booms ending in collapse, from the dot-com bubble to the U.S. housing bubble. This section will examine the anatomy of past crises, the warning signs we ignored, and how today's Chinese bubble shares the same DNA. Are we repeating history, or has China learned from past mistakes? What happens if the bubble pops? The worst-case scenario is clear. A wave of forced liquidations in China could spark a stock market crash, wiping out retail investors, crushing confidence, and threatening social stability. From there, the damage would spread to global markets. Commodity prices would sink, emerging markets would face capital flight, and Wall Street would confront a new wave of volatility. But there are also alternative scenarios. China could intervene with stimulus, regulators could impose new rules on margin lending, or global rate cuts could soften the blow. We'll map out the three main paths forward: the crash, the controlled reset, and the unlikely miracle of sustained growth. A world on edge. China's $322 billion margin bubble isn't just a local story, it's a global warning. It highlights how fragile today's markets are, how interconnected economies have become, and how quickly optimism can turn to fear. For investors, the message is simple: prepare for volatility, hedge your bets, diversify across assets, and remember that bubbles don't announce themselves before they burst. They just burst. September 2025 may be remembered as the month when the world learned just how dangerous too much borrowed money can be. If this breakdown opened your eyes to the risks in today's markets, smash the like button, subscribe for more urgent analysis, and drop your thoughts below. Will China's bubble burst? Is gold the only safe haven left? And how will Wall Street react if $322 billion in borrowed bets start to unravel? Your perspective matters, and tomorrow's headlines could make this story even bigger. This is Felix. See you next time.